Equilibrium is one of the core elements for understanding market liquidity. In this video, we will go through the essential basics of liquidity in Forex trading with smart money concepts. You will learn the interconnections between supply and demand in SMC. Like this video, subscribe to my YouTube channel and learn the nature of Forex market and what drives its prices. Let's start our discussion with understanding how Forex pairs move. The price of an asset goes up if the market demand is stronger than the market supply. The excessive buying interest makes the markets update the highs. In smart money concepts, such an event will also be called a buying imbalance. Please look at the price action on gold. The market is in a strong bullish rally. The price is going up because of the excess of demand, meaning that there are more buyers than the sellers for gold. This imbalance is what pushes the price up. In order to buy gold, buyers must find sellers. To entice sellers to enter the market, buyers need to offer a better price. At the same time, if the price of an asset goes down, it signifies that the market supply is stronger than the market demand. The excessive supply will make the markets update the lows. In SMC, it will be called a selling imbalance. You can see that the pound-dollar pair is falling strongly. This bearish rally is driven by the excess of the market supply. There are more sellers than the buyers for that currency at the current price. This imbalance is what pushes the prices down. The excessive supply or demand on the market cannot be permanent. The lower the price becomes, the more buyers will start buying, and the more sellers will start closing their positions. At some moment, the surplus of supply will be absorbed by the buyers. That will be a moment when the market will find equilibrium, the balance between supply and demand. Look at the dollar-yen pair. First, the market was falling strongly, and we got a clear selling imbalance. And the falling price did two things. It attracts new buyers. At the lower price, buying dollar-yen is more profitable, so new buyers enter the market. At the same time, the strong bearish rally discourages some sellers, considering that the price is already too low. The price of dollar-yen was falling till the market supply and the market demand finally matched. The excess of supply has been eliminated and the market found a balance. In a bull run, the higher the price will go, the more sellers will start selling. At some moment, buying imbalance will be absorbed by the bears and supply and demand will eventually find the balance. Such an event will be called equilibrium. You can see that though European pair was trading in a strong bullish rally, at some moment the price stopped updating the highs. The rising prices did two things. It attracted new sellers. At the higher price, selling European is more profitable. Those who bought earlier can close their trades in a nice profit now. At the same time, the rising prices discouraged some buyers. Some buyers who wanted to buy may decide that the price is too high now, canceling their order and reducing the overall demand. One of the main characteristics of a market equilibrium is a sideways movement and the termination of a formation of new highs or new lows. Usually such a sideways price action will form a horizontal range. Look what happened on a CAD-yen pair. First, the market was in a strong bearish trend and the market was falling because of the selling imbalance. Then the market found equilibrium, and you can see that the market stopped updating the lows, the market stopped updating new lower lows, and instead the market started to trade in sideways. We can see that the market started to respect a minor resistance and a minor support, and the market continued trading within that range for quite an extended time period. Learn smart money concepts SMC trading with my book. Get the essential basics of SMC trading and the complete trading strategy. For more info, visit my website, the link in the description below. The book is also available on Amazon. Such a range represents an equilibrium, a supply and demand balance. The range where each excess of the supply is absorbed by the demand and each excess of demand is absorbed by the supply. Please note that this equilibrium ranges will form on any time frame that you analyze. The rule is that the higher is the time frame of the formation of the range, the stronger is the market equilibrium. Here I have three different charts. On the left, I have dollar-yen pair on a daily time frame. In the middle, I have euro-yen pair on a 4-hour time frame, and on the right, I have pound-dollar pair on 15 minutes time frame. On each chart, we can easily spot the equilibrium ranges. While 15 minutes range on a pound-dollar pair may signify an intraday equilibrium, a sideways range on a 4-hour time frame will signify an intra-week equilibrium. A sideways movement on a dollar-yen pair on a daily time frame will signify an equilibrium in balance imbalance within a month. Market equilibrium cannot last forever. Fundamental news and changing market conditions will constantly make the market participants reassess a fair value of an asset. A violation of the range and a breakout of one of its boundaries will be a signal of an occurrence of an imbalance. A bullish violation of an upper boundary of the range will signify a bullish imbalance and a highly probable bullish continuation. Look what happened with gold. First, the market was rallying strongly and the market went up because of a strong bullish imbalance. Then the market found an equilibrium and the market started to consolidate within this horizontal range. Then, because of high impact news release, the price violated the resistance of the range. A new bullish imbalance occurred, and with that bullish imbalance, the market violated the resistance of the range. The market demand again started to exceed the market supply, and then the price went up to the new highs. While a bearish violation of a lower boundary of the range will signify a bearish imbalance and highly probable bearish continuation to the new lows. Examining a price action on Aussie dollar pair, the market was falling rapidly, and because of a strong bearish imbalance, the market dropped significantly. Then the market finally found a balance and the market started to trade in sideways range. The market found an equilibrium. Temporarily, the excess of the market supply was finally absorbed by the market demand. But then, because of the high impact US news, the market dropped again. We see a formation of a bearish imbalance, and because of that excess of supply, the market started to fall again and the price dropped way lower. For you as a trader, the ability to recognize the market equilibrium will help to identify profitable trading opportunities. With the absence of high impact news and fundamentals, you can expect that the consolidation within an equilibrium range will continue, selling from its resistance and buying from its support, while its breakout will indicate a future direction of the market and will provide a strong signal. Let's take that horizontal range on a dollar yen pair. You can see that once the market found a balance, the market started to trade within the sideways range, and the price is now staying within that for more than a month. And you can see that the price tested the resistance of the range multiple times already, and each time from that the price dropped strongly, and from the support of the range we got a lot of strong bullish movements, and obviously it is a very safe zone to buy dollar yen from. At the same time, when the price finally breaks a support or resistance of the range, it will provide an opportunity for us to buy the market in case of a bullish breakout of the resistance of the range, or sell the market if we see a confirmed violation of a support of the range. Learn to perceive a price chart as a battleground of buyers and sellers. Learn to recognize the excess of the market demand and the periods of equilibrium. Learn to identify the periods of the excess of supply and the consequent balance within sideways ranges. On this price chart on pound Swiss, we can see how nicely the market acted following the rules of supply and demand. Understanding the basic principles of supply and demand is essential for profitable trading Forex. Learn to recognize buying and selling imbalances and supply and demand equilibrium. It will provide you the edge in trading any Forex pair. Let me know in the comment section if you have any questions. Learn smart money concepts SMC with my book. For more info, check the link in the description below. Also traders, please watch my other videos. I have a lot of videos about SMC in this playlist.